Hello and welcome back to the Sovereign FX YouTube channel. So in this short forex trading video, we'll be discussing the importance of key levels in the forex market. Understanding key levels is an essential skill for any trader looking to make profitable trades in the market. Key levels are price levels that have historically acted as support or resistance, causing the price to either bounce off or break through them. As you can see on my chart, these are examples of key levels. Okay, so by identifying and understanding these key levels, traders can make informed trading decisions and increase their chances of success. So finally, in this video we'll discuss how to identify the levels, how to use them together with your trading strategy if you're not using them already, and examples of how key levels have influenced the markets in the past. Okay, so let's look at hands-on. Let me clear the charts. As I have talked about before, key levels are zones. Support and resistance are zones. Not exactly one price per se, but you could use the even numbers to help you get a better price point, because a lot of traders use even numbers and it, it becomes a self-fulfilling prophecy. When everyone looks at even numbers, the market is bound to react to even numbers, since market is moved based on fear and greed of the humans behind it. Okay, so here's how I draw mine. I'll have a zone. That's why I'm using a box. So these are the settings of my box. Someone asked me how my box stretches all the way to the end of the charts. These are the settings. Style, make sure it extends to right. Background can have an easy gray, lower the opacity, and there you have it. Okay, so we're not talking about which time frames yet, that will come later in the video, but I just want to show you how I plot the zones. So in this example, we have an area where price failed to break. So you want to have an average area of the wicks the candle produced, and make sure no candle closed below your area of interest, and that's where your key level comes in the middle of this box. Okay, so here you can smoothen it to 1832 600. Okay, so that's a key level, and you can use this level to watch how price interacts. So just based on glancing at the market, you can see this was a downtrend, and you can watch how price reacts to this resistance level. It came down, tapped, couldn't break below, shot up. Came down once again, tapped, couldn't close below, shot up. Came down the third time, tapped, couldn't close below, went up. So these are already 3 trades. And here, let's say in this instance, you took this trade expecting it to bounce off this area. This would have been 1 loss, and this would have been 3 wins. And if you have a risk to reward ratio of at least 1 to 3, here you'll have 3 wins, and here you'll have 1 loss. So technically, if you're using 10 pips to 30 pips, you'll have 90 minus 10, you'll have 80 pips worth of profit. But also, I've realized I wouldn't have taken this trade, since I only take trades if they break the high or the low of the I only take trades if they break the high or the low of the previous candle. So this didn't break the high of the previous candle, so I wouldn't take this buy. This nullifies the trade. But as you can see, price broke through, and once price breaks through, you need to watch the next candle. It comes up, rejects, couldn't break the high of the previous candle. This means price is in a downtrend, since price makes lower highs. As you can see, the wicks are lower highs. So this is how you'd have executed. This is just an example. You could have executed a sell there, and the flip of the current candle. And members of my group could have executed here or here or here, since price came back to our key level, our area of interest, couldn't break above, closed bearish, execute, and juice this whole move. Okay, I hope that has helped you at least understand how you plot your key level. So this was resistance, this was support turned resistance. As you can see, you can also plot this. This was your resistance, and as you can see, what happened here, price didn't turn this resistance into support. Okay, let's make this an even number. You can have 1840, 100, and price didn't make this a support. Price closed above, yes, but when price came down, it didn't bounce from this zone and broke back into our range. So this is the range, so this is what we call a fake out, and you would have caught this move to the lower area of the range at 60 pips. Okay, so let's go over time frames you can draw your zones. If you look at the daily time frame, it's not efficient for scalper, at least from my point of view, to draw the zones on the daily. You can only use the daily maybe to catch a glance of where the market's at. As of now, I can see the market's at around this area. This is a key level, an area of interest, and it broke through, and this is Friday, so we can wait for Monday and watch if the daily candle comes up, makes a top wick, doesn't break the previous candle, then enter a sell on the flip of the current daily candle. So I won't take the trade on the daily candle, but look for better entries on lower time frames, preferably the 30-minute time frame. Let's drop down to the 4 hours. So 4-hour levels are the strongest. As you can see, this is what happened. And you also don't want to scroll that far back, because you want the most you don't want to scroll that far back because you want the most what's the word for it, for lack of a better word, let's say beneficial, the most recent, basically the most recent key levels. So look at this, you had your key level, a zone, a collection of prices where price reacts is what constitutes a key level. So price made a resistance, this came back, couldn't break. You would have caught this at the break of the highs or the flip of the current candle. This is actually around 60 pips. Price broke below the area of interest, our key level, came back. So as you're waiting for it to form support above this to convert our resistance to support, it didn't. Basically, it broke back down, making sure the key level has already been broken, like simply enforcing the fact that this wouldn't be a resistance anymore. Oh, I mean support. It was a support previously, but once it broke support, it came back, couldn't form another support above, so it closed below, forming resistance. Execute it here for a short position, and you could target these areas. So you first take profit at 35 pips. I want 2, I want 3 stops obvious above here. So basically you get it. Drawing zones or key levels, you want to have a box, since it's a collection of prices, and you want to have a line cutting through to help you get more accurate entries. And this line, if you go to the price, you can have it as an even number, maybe 100, 500. Okay, so when price closes above this yellow line, you can watch the reaction, or when price approaches these areas, the key levels, you can watch whether it closes bullish, closes bearish, breaks it, pulls back, forms resistance to drop in the case of a downtrend. Yeah, so that's basically it. This is on the 4-hour. The 4-hour is the strongest for a scalper, and the best to plot is the hourly, but the best to execute is the 30 minutes. I hope you've gotten that clear. So strongest support and resistance key levels, 4 hours. Best support and resistance level to plot for scalpers during sessions is the 1 hour, and the best time frame to execute is the 30 minutes. So if you can use that confluence in your trading, you'll actually be ahead of the 90% of the traders in the market. So with that, I come to the end of this video, and I hope I've helped you understand the importance of key levels in the forex market. See you next time.